Welcome to the Ty and Rye the Finance Guys podcast, covering weekly investment news, important financial topics, and expert interviews. We want to help you become more knowledgeable about the financial world around you. This is not an offer to sell you anything, and remember, past performance doesn't indicate future results. Now your hosts, Ty Hansen and Ryan Robertson.
Hello and welcome to the latest episode in Ty and Rye the Finance Guys in our podcast. Unfortunately, this week it's just me, so hopefully it's not going to be too deep into the weeds, and hopefully it's still a little bit entertaining for you. So my business partner Ryan is actually he's out on a business trip. He's out visiting with some clients this week, and wasn't able to connect with me on the podcast. So it's all right though. We'll go ahead and press on. Right, we'll keep things rolling here. So yeah, we appreciate everybody that's listening to us. We've been getting some good feedback from everybody, and as always, we're excited to we're happy to bring you some information, and hopefully we help you understand a little bit better what's going on in the markets, how different pieces of the market work, things of that nature. So and one thing we can do if you ever have thoughts or ideas or things you would like to see in the podcast, check us out. Our website is tyandrye.com, or you can email either me or Ryan. It's just our first name, right? ty@myprosperteam.com, or ryan@myprosperteam.com. So, feel free to reach out to us anytime. So yeah, we'll go solo this week. It'll just be me and you sitting here, chewing the fat and talking about some finance stuff, and I will try very hard. One of my very good friends, Nate, he basically told me I'm a little bit boring, and that I dive a little too deep into the weeds. So we'll try and keep it a little bit more lighthearted and have some more fun with it today. But what we want to dive into, what I want to dive into today, just because I've noticed over the last little while, I've had a lot of conversations about these specific topics with a lot of my clients, a lot of my friends, a lot of family. And I want to talk about some really cool tax strategies, and as it relates to like new contributions and managing your contributions to your 401k, your IRA, your SEPs, those kinds of things. They're very basic in nature, right? They're pretty simple concepts, but I think if we understand a few of the moving pieces behind how we build these out, we will be able to maximize the efficacy, right? We'll be able to keep as many of the dollars in our pocket and pay fewer dollars to the IRS, right? That's always the number one goal. And not only do we want to accomplish that, but we want to accomplish it in a way that doesn't set you up for potential risk, right? I never want my clients to be at risk of an IRS audit, things of that nature. I will say, like I always do, I am not a CPA. I'm not giving tax advice. I've done this a long time, and I've worked with hundreds of CPAs. So, again, my background, finance, bachelor's, master's of finance. But again, I'm not a CPA. So take this all with a grain of salt. And I always highly, highly recommend that you do work with a good qualified CPA. In fact, I've got a great guy. I'll put a plug out there for Val Gibson of Gibson Shirts. I love Val. Val takes care of me, and he has saved me thousands of dollars over the years. So great guy, works really hard, and he takes care of all of the crappy tax stuff that I don't want to deal with. So I love Val. Val's the man. So, but yeah, no, I want to dive into some ideas here. I want to jump into some ideas of, again, some tax strategies as it relates to your retirement accounts, and how do we manage some contributions? Because there's a few topics here that I'm pretty sure you haven't ever heard of. So the other thing I want to make sure we do is, as I walk through this, I'll try really hard, again, at the advice of my good buddy Nate. He's one of my best friends. We've been good friends for a long, long time. at his recommendation, I'm going to try and keep things a little more organized, right? Because my brain, the way that it tangents is awesome. In my world, it's awesome. I love how I tangent. But for you, the listener, I'm sure you're like, okay, shut up, Ty, get on point. So anyways, so let's start off. So, okay, how do we contribute and why do we contribute to a retirement account, right? So, the idea here is that there's some definite benefits to it, but there's also some potential pitfalls we want to be cautious of, right? So the how and why do we even do this? Whether it's, and here I'll take a second to run through that. So, most people are familiar with their employer 401k plan, right? You go work for Walmart, you work for Western Building Group, right? You work for, I don't know, anybody. You name the company. Most of them have a 401k, right? And that's what most people use for their retirement. You also maybe have an IRA with Fidelity or Charles Schwab or with whomever, right? It doesn't matter. Self-employed people may have a SEP IRA or a simple IRA. There's also 403Bs. These are all retirement accounts, right? And the idea basically is the IRS wants us to be as little of a burden on the IRS as possible, right? So they're like, look, if we can get you to save more money, you're not going to be as much of a burden on the system. I mean, you're still going to most likely get Social Security, which there's debate there whether or not you will, but that's the whole point with this, right? Is the IRS wants us to have incentives to save for retirement, and so that's what the whole retirement world is built around, right? Is that the IRS gives us some benefits, and so again, that's what I want to talk about. How do we maximize that, right? And so the idea is that you have a choice, right? You have a choice of, okay, either I put money in as a Roth contribution or post-tax contribution, or you can put it in as a traditional contribution or pre-tax. So pre and post, pre-tax is traditional, post-tax is Roth. And the idea is, do I want tax savings today, this year, or do I want the tax savings down the road, right? And some people will say, well, which is better, Ty? Which is the right way to go? And I even see companies out there that push really, really hard to say, oh, you should do it all this way, or you should do it all that way. And even too, Val, my tax guy, he's like, hey, you should do more traditional. You should do more pre-tax. But I choose not to. I elect not to. Okay. So again, you might see a Roth 401k, or you may have a Roth IRA, or you may have a traditional or pre-tax 401k or a traditional IRA, right? It's the same concept in any of these different retirement accounts, right? Again, Roth is pre-tax, traditional is post-tax, right? Sorry. I said that backwards. Roth is after taxes. Traditional is pre-tax. So, and the idea is like, okay, if I'm gonna make $100,000, right? Or no, let's do $120,000. I'm making $10,000 a month. I'm gonna be taxed. Well, if that money is going into a traditional 401k with my employer is gonna say, okay, we're gonna hold back X number of dollars. We'll call it $500, right? You're gonna hold back $500. So now my taxable income is $9,500, not $10,000. Right, and that goes into my retirement account, okay? If it's Roth elected, I get taxed on the $10,000 first, and then it pulls off $500 and puts it into the account, okay? So again, I don't get any of the tax benefits today, right? I'm paying all the taxes today, but I'll talk about in a second how that works down the road. Keep in mind, too, that if you do your own IRA, right? So again, I get like... So with an employer plan, they take care of the logistics for you where they put the money in there. You get your tax benefit today, right? So when you so again, coming back to that, I make $10,000 a month. So if I were to get that $10,000 paycheck, I'm going to see a whole bunch of line items of taxes that are paid, right? Social Security, Medicaid, all that fun stuff, right? FICA, all the beautiful things we all love to see on our paychecks. So if it's an employer plan where they pull that money out, that 500 out before, you're going to see those dollar amounts lower, right? Because it's saving me on the taxes now. If I did a traditional IRA, however, though, so again, I still get taxed with my employer. So I pay a little bit more in all those socials or different tax buckets, and then I put $500 into my IRA. You're still going to get a tax benefit, but it's just not today. It's basically next time you file your returns, the IRS wants to know, okay, well, great, you're filing your returns. How much did you contribute to a traditional IRA? And you say, oh, well, I actually put, $6,000, right? $500 a month. I did $6,000. And they say, oh, okay, well, technically, every month when you did your paycheck, those line items that you paid taxes, and you overpaid. You put a little bit too much in there, right? Because we didn't know when you were doing your paycheck, we didn't know that you were putting more money into an IRA. We do know now because you're telling us, so here's a refund, right? Let's say if your refund was going to be $2,000, your refund may be like $2,200 now or $2,300, right? So that's that. So again, a traditional IRA has the same benefits as a traditional 401k. It's just the timing of when you get the benefits. Okay, so you still get them. Again, Roth, though, doesn't matter if you do Roth IRA, Roth 401k, you're still always going to pay those taxes today. Now, the idea is, okay, well, why Roth versus traditional? Which is better? And the short answer is, it depends. It's up to you, right? If I'm in a really high tax bracket today, doesn't it make sense to cram as much into a retirement account so I pay less in taxes today, right? Time value of money would tell us we want more dollars saved today than 15 years down the road because my dollar's worth more today than anything. Then what happens? So again, think about that. So we contribute to these accounts, these 401ks, these IRAs, and then fast forward now when you get into retirement, the difference is now in retirement, every dollar I pull out of a traditional 401k or a traditional IRA or a SEP or whatever it is, every dollar you pull out, it gets treated at that moment as ordinary income tax. You get a 1099 on it. So if now I'm 70 years old, well, let's say I'm 65. I'm 65. I'm retiring. I want money. I pull $20,000 out of my retirement account because it was traditional or pre-tax. I pay the taxes then at age 65. Right? So I saved the taxes when I was younger. So I'm 40. It's been an interesting year, turning 40. But I'm 40. So I saved my taxes when I was 40, but when I'm 65, now I'm paying the piper at that point. Right? So again, the idea is I'm at a higher tax bracket when I'm 40. If I'm retired, my tax bracket's lower, so ergo it makes sense to pay less. That's going to save me the most taxes. The idea with Roth, however, is I don't care today if I get my tax deduction, because when I go to now pull that Roth out at age 65, I pull that dollar out completely tax-free, 100%. So I pull out $20,000 in retirement, and I don't pay a penny in taxes on that $20,000. Again, do I want the savings today or do I want it later? There are strategies that make sense for actually both of those options, and it just depends on the individual. It really does. Now, keep in mind too, even though let's just say today I would say like by trimming down my my taxable dollars today at age 40, by trimming that down, let's say maybe I save $1,000 or $2,000 in taxes today. This is an important piece to understand. When I'm in retirement, not only am I taxed on the dollar I put in, but if that $1 grew to $20, I'm actually paying taxes on the $1 plus the 19 of growth. It's all taxed as ordinary income. So that is the fundamental kind of I don't want to say argument, but debate as Roth versus traditional is. Well, now I have all these gains that I don't have to pay any taxes on at all in the Roth. So Roth's pretty good. Roth's pretty powerful. And so, in fact, I had a client who, and we're going to talk about Roth conversions in just a second. So I had a client who, she took the distribution. This was like 2 years ago. But prior to that, 2 years ago, we had spent about 5 or 6 years converting part of her accounts to Roth. And what a Roth conversion is okay, Ty, I've built up $500,000. It's all pre-tax. Now I'm, 55. I'm going to be retiring in 5 or 10 years. What can I do to help, lessen the blow of taxes? I don't want to just have everything, in that pre-tax bucket. So we convert parts of it every year. And there's and I'm not going to get into the details, but there's a very specific way to do it. It's called marginal tax planning, right? And so the idea is that you make sure you keep yourself into specific tax bracket ranges. So you don't want to convert all, if you have 500,000, you don't do all 500,000 in 1 year, or you're paying taxes on 500,000. That's not very efficient, right? Okay, so we converted. I had done this for about 6 or 7 years for this lady. Now fast forward, she's needing to pull monies out. At the year, so at the time, a couple of years ago when we pulled the chunk of change out for her, if it had all been in pre-tax, she would have ended up paying about $4,000 to $5,000 in taxes to access or to get those monies, right? So, because we had converted to Roth, right, and because we had had done those things we're talking about, we were able to pull some from the pre-tax account, some from the Roth, and some from her regular individual account, and effectively we kept the taxes closer to like $800 or $900. Right, because of the way we were able to pull it out, right? So that's what's powerful about these concepts is there's not one right answer. It's just understanding how these both work, and making sure that we really work the tax system with a combination of the two, so we're getting the best. The other thing too, the other idea that I like with Roth is, look, I don't know what government tax rates are going to be when I'm 65, but I know what they are today. And so I'm going to take advantage of doing some Roth conversion today, so I know I've already paid the piper. So it's like you're hedging your bet is what you're doing, right? So that's the Roth conversion. The other last thought with this too, before I move into I want to talk about 401ks, the solo 401ks and their contribution limits. But before I do that, just so you know, you can have multiple accounts. So you can have an account with your employer, right? You work for, again, my buddy Nate works, he works for a company. His company he works for, you can have that retirement plan. You can also have a traditional IRA. And then you can also have a solo 401k, right? And I'm gonna jump into that solo 401k right now, or like a SEP, because the IRA, the traditional IRA and Roth IRA are limited to $6,000 a year or $7,000 a year, depending on your age. If you're over 50 years of age, it's $7,000 a year for husband and wife, or married couples, right? So not both couples don't have to be working, right? So like if my wife is a stay-at-home mom and has no earned income, she can rely on my earned income for contributions, right? Or whatever, vice versa. And both of my wife and I can both contribute $6,000 a year, so $12,000 total. So you can have your employer plan, right, with my company that I work for that's paying me a W-2 salary. I can also contribute my $6,000 a year. My wife can contribute $6,000 a year based on my income. And then if I have a self-employed business, I can also build a 401k for that, or a SEP IRA or simple IRA. Okay, so there's a lot of different accounts that you can utilize to contribute into your retirement. Okay, so let's shift those gears. Now let's talk about solo 401ks, right? So the difference is, right, pretty much everybody listening now is used to or knows about the 401k plan with their employer, right? Okay, yeah, I work for Johnson & Johnson. I put in, if I put in 3%, they match 3%. And then if I put anything above that, then they don't match, right? Or some variation of that. That's how most employer plans work, right? That basically, and again, Roth or traditional, most plans allow for both, so you can choose, right? The solo 401k is a little different. Solo 401k, you're the one wearing both hats. You're wearing the employer hat and the employee hat, okay? The cool thing with the solo 401k is it allows you to put a lot more money in, right? Your max contribution amount, depending on how much is being matched from the employer, is $19,500, right, in an employer plan. So there's some caps there. Still better than the Roth, the IRAs, but you're still capped. The solo 401k, you can go up to $58,000 or $64,500 if you're older, if you're over 50, right? So you've got a lot bigger window. And if you and your spouse or significant other are both owners of that business, you can both do it. Okay? Now, there's a few variations of this. I don't want to get into too much in the details, but there's basically two buckets that you fill in here, right? There's two buckets you throw money into. Either you're doing profit sharing or you're doing deferred compensation. Deferred compensation is what we're all really used to in our 401k. Like I talked about, right? If I'm making 10 grand a month and I take part of that money out and I put it into the retirement, that's taking I'm deferring my compensation. I'm taking my compensation rather than putting it in my bank account and spending it, right? Whatever. That money is being deferred into my plan. So in the solo 401k, you've got that deferred compensation option and you've got profit sharing. Okay. Now, this is interesting. A real powerful tax strategy tool with this solo 401k is that you can immediately convert all dollars to Roth, right? I've heard people talk about the golden Roth or there have been so many random variations I've seen of this, but this really powerful Roth tool. So what happens, let me take a step back. So in a Roth IRA, right? Okay, $6,000 a year, $7,000 a year. Actually, you can phase out of being able to even make those contributions if you make too much money. So if you and your wife make too much money, it's about 150 to 200,000 in that range, depending on if you're single. It's really easy to find those limitations, but the limits. But so you may even lose out of the option to do Roth. However, in the solo 401k, if you're making more money, they would initially go in as tax deductible, or as the pre-tax, right? But then what happens is you immediately convert it to Roth. So it's like, you're essentially going to contribute $1 that gives you tax savings, and then you're going to convert, which is going to be, you're going to be taxed. So it's like it offsets itself, right? So you don't end up with any tax savings for the business or for you personally in the given year. But again, you may decide, I don't care. I don't really need the tax benefit or want the tax benefit. I want the Roth. So again, this solo 401k contribution, this tax strategy, you could effectively put almost $65,000 or almost $130,000 if it's you and a significant other, you and a spouse. You can put that much away a year Roth elected. And there's no phase outs for income with that. None. Right? So if you're making $300,000 a year and you want to build, again, some people may say, well, why don't you want the pre-tax, Ty, if you're making $300,000 a year? Again, it's personal preference, right? Again, Val tells me all the time, he's like, Ty, you should do more traditional. You're going to save more tax. I'm like, I don't care. I'm fine paying the piper today. I would rather pay the piper today because I'm pretty confident I'm going to grow those dollars over the next 25 years. So think about that. This golden Roth tax strategy, powerful. Right? Really powerful. Okay. So still looking under this idea of the solo 401k, employer 401k. Actually, no, let's focus on the solo 401k. So you've got to make sure we understand that it's tied to a business. And I said before, you can have 5, 10, you can have 10 or 15. I mean, I don't know why you'd have that many, but you can have 3 or 4 solo 401k plans. It doesn't matter. You can have as many of those as you want, and they each have their own limits. They do, however, have to be tied to one specific business income flow, right? So let's say that you are a software engineer and you also have a landscaping business, right? Well, let's say as a software engineer, you work for a company, they pay you $150,000 a year salary, but you also do contracting on the side, like you do some independent work and you make $50,000. And your landscaping business you run pays another $50,000. Okay, so $150,000 for my regular job, $50,000 for my contracting job, $50,000 from my landscaping job. Okay. So I could be maxing out my employer plan with my regular $150,000 job, my salary. I could be putting part of now you can't put, if let's say you're 52 years old and you're the software engineer, you couldn't do the 64,500 because you didn't make that much. You can't ever, the IRS won't let you put more than you earn. But some dollar percentage of that 50,000 you can be putting away, and that's its own separate calculation. Same thing with the landscaping job. So you'd have two separate solo 401ks. And you could still be doing a regular IRA contribution. So that's 4 different buckets this software engineer could have. His employer-sponsored plan, his traditional IRA, his personal IRA, his solo 401k for consulting, and his solo 401k for landscaping, right? So it's pretty interesting. So, but the key here is, remember, believe me, I've helped a lot of people with these things, and you've got to be pretty good about keeping tabs on where the monies are coming from. Because at the end of the year, you got to do the taxes, or your CPA is going to do taxes. I don't want your CPA calling me like, what in the hell did you talk to this guy about doing or this gal about doing, right? We don't want to do that. You want to make sure it's tied to you got to tie it to the right business, make sure there's enough revenues. And there's actually some other, ways to calculate exactly how much money you can contribute, right? But you got to, anyways, you got to make sure you're tied to the right business. The other thing too, if you have a solo 401k, you can't have employees unless you're providing a plan to them, right? So if I've got, that landscaping business, if I've got, 5 or 6 people that work for me, if I'm not providing some sort of retirement benefit to them, I can't do that solo 401k because the IRS doesn't want you getting a benefit if you're not giving to your people. Okay, so the other thing with any of these 401ks, which may give you some tax benefits, is being able to take a 401k loan out, right? So think about that. If I want to pull, so with everything, there's a big overarching umbrella to this whole thing is once you put monies into a retirement account, they are locked. I mean, you can move the money wherever you want unless your employer won't let you move your money, which is the case a lot of times. But you're locked in there because if you pull your monies out too early, you get hit with penalties. Okay, and again, the reason for that is the IRS wants you to. They kind of want to like lock you in a little bit so that you don't just put $1,000 in, pull $1,000 out. You know what I mean? So there are some penalties, but you can still access that money without any penalties or taxes through a 401k loan. Okay, now they're capped at $50,000, and some institutions may charge you a fee for it. We don't charge our clients anything for them if they want to take a loan out. What happens though is, so that money comes out of the 401k retirement world and it goes into your regular normal bucket, right? Your savings account, your checking account. You do have to repay it, so there is a payment, and you are paying interest, but you're not paying a bank, you're paying yourself, right? So it's a pretty cool tool. I have clients all the time, they're like, Ty, I need to get some money, but I don't want to pay the taxes or penalties. Like, that's okay, let's do the solo 401k loan. Pull 20 grand out, go do it, whatever. Again, you have to repay it, so there's some pros and cons, but there's no penalty or taxes to access that, right? Now, there is a problem if you end up closing down the plan or you don't make repayments, you will be taxed on those dollars that were in the loan. You will be. And I've seen that before. I've seen clients who take a loan, decide they don't, either want to shut down the plan or decide whatever, or they don't want to repay, and you get a big 1099 for whatever you got. So you got to be careful with it. Last few ideas with some do's and don'ts within the solo 401k. The big do is to make sure that you keep good tabs on what you're tying the business to, right? So it's like if I'm this software engineer, right? We don't want to tie, like we don't want to muddy the waters. We don't want some of the monies being contributed coming from the landscaping company or some from the consulting gig. Like you need to take some initiative to do some good record keeping, okay? The other thing is, again, I always like to tell clients, we want to name those plans because you have when you do a solo K, you can name it whatever you want. It doesn't matter because you're self-managing the whole thing, right? But I like to name it whatever that business is or have some tie to that business so we know what it is. So again, it's tied to a very specific business. The other thing too, I have a lot of clients that will buy real estate with their solo 401ks, or buy tax liens, or invest in all kinds of crazy things. They may want some additional asset protection via an LLC, right? Like a lot of times clients will go buy property and they'll put the property into an LLC to limit liability, okay? Which is that's a good strategy in and of itself, right? And we can talk about that later. You gotta be careful though when you do that with a solo 401k. This is the number one mistake I see clients make all the time, okay? Remember, once money goes into a 401k or an IRA, it kind of leaves your personal bucket and goes into the retirement bucket until we do a distribution, which, distribution is a taxable event. Or maybe there's no taxes, but it's still technically a tax transfer, even with the Roth. It's a tax distribution, but there's just no taxes on it. Okay, so that's when the money comes out. That's a distribution event. So it's almost like while the money's in the retirement, it's its own separate person. I know it's your money, but think of it that way. It's its own separate person. Okay, so Ty Hansen versus Ty Hansen 401k, they're almost like two different people. Okay, and there's specific rules how those monies can be meshed together, or how they should not be meshed together is the more appropriate way to put it. Okay, so the long and short is, don't mix personal money into an investment with 401k monies. Gets messy. The IRS does not like that. It's called commingling. Don't do it. Okay. Same thing if I'm using an entity, right? So if my 401k is buying a property and I want an LLC, the LLC that owns the property that was funded from the 401k should be owned by 401k, not by Ty Hansen individual. See the difference? Ty Hansen individual, if Ty Hansen individual is the owner manager of the LLC for that property, technically I have personal access to the money. The IRS is not going to be happy about that. But if Ty Hansen 401k is the owner of that LLC, we're fine, totally fine. Okay? So again, it's the primary thing with a solo 401k, this is awesome. Again, remember, we've got that huge Roth option, huge Roth strategy we can do in there. We've got a higher limit. We can put more money in. It gives us another bucket that we can throw more monies into if we want. There's actually even more tax strategies that are pretty powerful with that 401k, but we're not going to dive into that this second. So just make sure you keep good accounting of those dollars in and dollars out. Okay. So, all right, we've talked about the hows and whys and how to contribute in the different options. We've talked about solo 401k. Let's jump into one last key retirement tool here. That it's funny because it's actually the oldest and the most widely like one of the oldest used retirement accounts and plans, but most people wouldn't know it if we talked to them about it. It's what we call a defined benefit plan. So a 401k is actually a defined contribution plan. A defined benefit is just that. So the difference between those two is contribution versus benefit. So a defined benefit plan is really the old school pension, right? That's really what it is. And the reason it shifted away from that, we'll go into a little history here for a second. So the old defined benefit plan, you worked for a company for 20 years, right? You worked for General Electric, or you worked for Union Pacific, or here in Utah, we had Geneva Steel. You worked for Geneva Steel and you had a pension. Those companies would say, okay, you work here for so long, we're going to pay you X dollars for the rest of your life, right? Cool. That's a defined benefit. I know exactly what my benefit's going to be when I retire. Well, over time, people, they weren't as connected to who they were working for. We changed jobs more often. The landscape in the working world has changed. And so, and it's, to be frank, it's pretty risky for a business to say, I'm going to guarantee I'm paying you X number of dollars, right? That's a big liability. In fact, we're seeing, government entities, like counties and cities and different pension plans that are in big trouble, right? Because these pensions exist and they have to pay their people who retire X dollars. If they're not funded right, it's scary stuff that they can really jack up. So we saw this evolution of, okay, we're not doing a pension anymore. We still want to give a benefit. So we're going to give you a 401k, which is a defined contribution, right? That's easy. That's easy to say, okay, here's what we're going to do. I'm not going to guarantee how much you get in cash flow, what your benefit's going to be when you're done, when you retire, but I can guarantee how much I'm going to contribute into your plan, right? So you're going to put 3%. I guarantee I'll give you 3% every pay period. I'll give that to you, no problem. That's the difference, right? So that's why we see nowadays it's primarily 401k, right? So let's take a step back. This defined pension plan or defined benefit plan or pension, right? Those still exist and you can do them and they are crazy powerful, right? You can actually put into these $230,000 a year, right? $230,000 a year in contribution limits. Again, let's go back to the software engineer. Let's say he's making $1 million a year, right? He could technically do his employer plan, his solo 401k for his consulting, his solo 401k for his landscaping, and he could do a defined benefit plan. Again, they have to be separate income sources, but depending on how much money you make, you can do this defined benefit plan. Now, they're very risky in the sense that, again, you have to know what the benefit to the employee is going to be, which you're your own employee, right? But there are tools that we have that we know exactly how to build to guarantee. Typically, we build an annuity. That's what we do. We say, okay, this year you're going to put in $200,000, and that $200,000 has to guarantee so much cash flow when you retire at age 65. Well, we can do an annuity. An annuity guarantees exactly what the cash flows will be. So again, there's this last bucket, this defined benefit plan that you can build that unlocks $230,000 worth of contribution amounts a year. It's pretty powerful stuff. And I mean, even if you're not going up to 230,000, that may be something that somebody that's like, hey, I'm looking to get, 50 to 100 extra $1,000. That may be the choice over the solo 401k. So anyways, so just to kind of recap and kind of sum everything up. So what's the whole point of doing all of these things, right? Why do we want to do this? A couple of thoughts. For people on the lower end of the spectrum of, they're putting away $50 a month. Why do we want to do this? My thought is we want to get into the habit of making contributions because, again, there's really pensions are kind of going the way of the dodo. They're not going to be around. Yeah, Social Security should be there when you retire. But to be frank, I don't want to be reliant upon the federal government to support me in my retirement. So on the low end of the spectrum, if you're putting $50 or $100 a month away, the power is that it kind of locks you in a little bit. You put the money in there. It's like, yeah, if you pull that out early, you're going to get hit with some penalties. So it's like, you just got to be willing to say, okay, I'm putting that money in there. It's locked up and I'm just not going to think about it. I always tell people it's like your cable bill, right? How often do we think about our cable bill, our AT&T bill? I use AT&T for my cell phone bill, right? How often do we think about those things, right? We don't. That's what I'm saying on this low end of the spectrum. That's why these are powerful, is it's almost like it can turn into something you set and forget. Look, if you're younger and you're putting away $100, $200 a month, the math works out that by the time you're 65, if you have a decent rate of return, between 5 and 8%, 5 and 9% on average, you're talking, $500,000, maybe $1 million. It's pretty powerful stuff. And I would rather, kind of put if I'm at this end of the spectrum, I want to put my blinders on and just plug away for 20, 30 years and just slowly be putting a little bit of money away. And then also when I get to retirement, it's like, oh, sweet, I don't have to really worry about Social Security. I mean, maybe I get it and that's great. It's gravy. But, okay, good. I've got 300,000 or 400,000. Now, is that going to be an extravagant retirement? No, not at all. But you're going to be able to retire and be okay. Again, I build financial plans all the time, built thousands of them. So it's okay. It can work with, 300, 400, or 500,000, right? Okay, so that's that end of the spectrum. The other end of the spectrum, it's like, why do we worry about these? Look, if you're making good money, 100,000, 2, 3, 400,000. We want to be as tax efficient as we can, right? So we've got the employer 401k, we've got the solo 401k, we've got the defined benefit plan, we've got the regular IRA and Roth IRA. Let's use these tools to save and really craft something that minimizes that tax that we're paying to the IRS, right? Let's do that. Or even too, if you've just kind of been plugging away with your employer plan for 10, 15 years, you've amassed $500,000, $2 million in your 401k. Let's look at converting. Let's look at how we can strategize with tax planning over the next 5 or 6 years, 10 years before you retire, so that you're literally you're getting every cent out of that dollar you can, right? Again, that's this idea of marginal tax planning, right? It's what I do for people all the time. We look at your taxes, how much are you paying, and we look at, okay, how much can I pull out before I really bump you up into another major tax bracket, right? We don't want to get you so on such a high level that you're starting to phase out of tax benefits, right? So that's really the point here is getting yourself into the habit of saving. And then as we evolve and we've got more money and we're making more money, let's maximize that dollar, because to be frank, it's actually pretty easy, right? People all the time are like, I don't want to pay this much in taxes. It's like, awesome. There's some ways we can work this. Now, you're going to pay taxes, right? You can't get out of paying taxes. Nobody can. Unfortunately, that's the world we live in. But I hear people all the time too. They're like, stinking Wall Street and this and that and the 1%ers and I'm like, look, those rules still apply to you. You can still use those tax benefits. Let's play the game, right? That's why we're here. That's why we're doing what we're doing. So there you go. A couple of tax strategies, tax ideas, tax strategies. A couple of different buckets you can contribute to. And a couple of different ways that you start structuring this the right way. You're not just throwing your dollars into your savings account. Now you're in your 50s, 60s, 70s, and your retirement years. Again, it's so fun. I love this. When I sit with a client and we pull money out of their account, and it's like they're like, oh, like I thought I was gonna be paying a lot more in tax. Like, no. We've done this the right way. It's fun. It's awesome. Again, I geek out about this stuff. So, all right. I think I have bored all of you long enough, and I've enjoyed doing this solo. It's been pretty fun. So, thank you for the listen. We appreciate it. Remember, check us out, tyandrye.com. And we would love it, seriously, any feedback. My email, ty at myprosperteam.com or Ryan at myprosperteam.com. Email us anytime. We are happy to get feedback on the podcast. We want to know some things you want to hear and how we can make this more enjoyable for you. So appreciate it. You guys have a great weekend, and we thank you for following.
Hey, thanks for listening to the Ty and Rye, the Finance Guys podcast today. If you like what you heard, go ahead and hit subscribe. That way you won't miss any future episodes. Also, follow us on Instagram, Twitter, Facebook, Ty and Rye podcast. Also, check us out at myprosperteam.com. Thanks. We will see you next week.